Hello, welcome back traders. In today's lesson, we are breaking down one of the key concepts in technical analysis, support and resistance. If you truly understand support and resistance levels, you'll be able to identify market direction, time your entries with confidence, and know exactly when to exit, whether at profit or at loss. What is support? Support is what we call the price floor. It's that area on the chart where price tends to stop falling and begins to reverse. What does this really mean? It means that buyers find the price attractive and demand increases, whereby selling pressure also slows down. This causes the market to do two things: either bounce off the zone or break through to create a move that will take us to the next support zone. Just like we see on the chart here, a zone was established around this level here. Price moved away from it, trended upward. When price came back to that same level downwards, there was a reaction at that point. That support acted as a level where market bounced off and went to the upside, came back down there again, still bounced off that level, went back up again, giving us a structural shift, came back down again, bounced at that point, then we had the move go to the upside. So once you understand this concept of support and resistance, you will see the market in a different light. What is resistance? Resistance is the opposite of support. It's a point where an uptrend pauses or reverses because sellers became active. The same thing, sellers saw that price at an attractive price. There was an increase in supply and buyers had some slowdown and price went to the downside. Two things happens also when price gets to resistance. Price respects the level and reverses downward, or price breaks and gets us to a potential level upward again. Like we've seen on the chart here, a level was established here. When price got to this level, price came back downward. As it went up again, the level responded, came back down again, went back to that same point. We had a reaction. Price came back down. That same low zone and level reacted, and we got price pushing to the downside. So these levels of support and resistance are simply psychological level where traders tend to react when price gets to that point. Once you learn to see this reaction, your chart becomes easy to read and you will know where price is targeting at every particular point. Price is moving. Price is either targeting a support or is targeting a resistance. Once that support or resistance breaks, it targets the next one. Types of support and resistance. Two major categories of support and resistance. We have the static level support and resistance, and we have the dynamic support and resistance. The static support and resistance are levels that are fixed in the market. They don't move with price. They remain constant over time, and some of these levels are reliable levels because when price moves out of them, it comes back and meet them at the same point. So levels like the horizontal level, the psychological level, supply and demand zone are static level. Previous highs and previous swing points, previous daily lows and previous daily highs, previous weekly highs and previous weekly lows, previous monthly highs and previous monthly lows. Price tends to respect these levels and they act as self-fulfilling prophecy when price gets to those levels. So they don't move as price moves. Price either moves away from it and comes back to it and uses it as a level, support and resistance level, or price drives above or below it, breaks it and uses it as a flip zone. The next is dynamic support and resistance. Dynamic support and resistance are levels that moves with price, and the levels adjust based on market condition, and they are mostly tool based. Like the moving averages we use are trend line and our Fibonacci retracement levels. Those are dynamic levels. As price is moving, we use these tools to plot on the chart to see possible movement where price can find support or resistance. So if price is moving in this direction and we've gotten 2 points of reaction like this, if we draw a trend line moving this way, the suggestion here is that once price gets back down, it's going to use this trend line as a support level to push price up to the upside again. So if price still comes down, we've gotten the 2 levels marked out again. These 2 levels are extended. Price in the future comes back and meets the trend line, is going to act as a support. But eventually, if price breaks it down, it has violated the trend line and we've seen a change in direction already. So for a moving average, once we get price moving, if price is above the moving average is going to act as support. If price is below the moving average is going to act as resistance. So we'll get more practical when we get deeper into the course. So that's static and dynamic support and resistance. Static and dynamic support and resistance. Sustained break of a support or resistance zone. A sustained break is when we get a level of support or resistance broken with consecutive candlesticks body closing above the zone. If we get a support level here and we get a break above the level with a candlestick body closing above the level with consecutive candlestick, we've gotten a sustained break of that level. Not having a candlestick go above the level, but before it closes, it comes back and closes below the level. With this, we are going to have a wick to the upside. So this is not a sustained break. This is also telling us rejection and that this level is still valid. So the level is rejecting price going up. But at the moment where we get candlestick with the body close and we get consecutive candles with bodies closing above the level, we've gotten a sustained break of the support or resistance zone. At this point, it is resistance being broken. When we get it to the downside, continuous candlestick closing to the downside, it tells us that we've gotten a sustained break to the downside. So that's sustained break where we have consecutive candlestick bodies closing above the level for resistance and consecutive candlestick with bodies closing below the level with candlestick bodies. So that's sustained break. The next is fake outs. Fake out of support and resistance zone. Like I've mentioned earlier, when we get a level and we get a candlestick going above the level, but before this candlestick closes, it comes back and closes below the level, which is going to give us a wick to the upside. So fake out happens when price breaks a level briefly, but then reverses strongly in the opposite direction. This is the easiest way. The easiest way to avoid fake out is to wait for candlesticks to close. At every point in time where a candlestick is piercing a support or resistance level, that level is not considered broken or rejected if that candlestick has not closed. So we have to wait for that candlestick to close so that it can give us the information that we need to get out of that level. So if we have a candlestick closed above the body, then the next candle comes back and closes below the level again. This is also telling us that this is a fake out. So we need to wait for candlestick closure to really understand what we are going to have, if we are having a breakout or a fake out, so that we don't put ourselves in a position where the market will definitely go against us and take us out in a loss. Zone flip. where resistance becomes support and support becomes resistance. So zone flip happens when support becomes resistance or resistance becomes support. It is known as role reversal. Once a support level is broken downwards, this level that was support before now becomes resistance because price is below it. When we get a pull back into the move, price will use that level that was support that becomes resistance now for markets to continue to the downside. The same thing happens in reverse. Once the level is broken, a resistance, price going upward, breaks the resistance has turned to support. So when price is coming downward again, pull back, it uses the level as support to push to the upside. So zone flip is when levels changes from support to resistance and resistance changing to support. Just like the example we have here, support zone becomes resistance. Price went up all this way, came back, we found support here, went back, came back, support, went back up, came back down, broke the support level, and it's now becoming resistance to push price to the downside. So these levels happens when we get a break of support, we get resistance showing up when the level is being flipped. The next is resistance becoming support. Price upside, we had resistance up, resistance, price went back up, support, market moved, came back down, acted as support, then push, price went to the upside. So these levels are there in the market where we can use it to take advantage of trading on the chart. A quick one, once price gets to support, what we need to see that will give us a heads up that we're about going the other direction are the bullish candlestick pattern. So at support, we anticipate to see bullish candlestick patterns. At resistance, we anticipate to see bearish candlestick patterns that will push price in the direction where we anticipate it to get to. So support and resistance is one of the simplest yet most powerful tools you can use in technical analysis. If you can identify the market direction, time your entries, and know your point of exit, then you've essentially completed your trading idea. So support and resistance helps us prime our market direction, know our trading entries in the market, and point where we are going to get out of the market in a loss. So thank you for watching and stay tuned for more trading lessons as we progress. Thank you.